Hello and welcome to our latest video. My name is Dave Syme. I'm an attorney. I operate out of the San Francisco office. Today's topic is going to be on trusts. And I'll tell you, trusts are typically the least jazzy subject in all of law school. It's not a popular topic. However, you will see that today I'm going to teach you how to save money and keep the money that you earn. And that's important. So this will be very near and dear to some of our clients who are about to come into a huge amount of money and are interested in trying to keep a hold of as much as they can. As usual, the following information should not be taken as legal advice. It should not be taken as accounting advice. You should go consult your own attorney, your own accountants. Everybody's tax situation is different. Everybody's legal situation is different. And we wouldn't propose to give you any specific advice without understanding your situation well. So with that caveat, we will continue on to the main presentation. Corporations have often been in business maybe 4, 5, 6 years. They're doing well, they're generating strong revenue, everything's going nicely, and they're ready to take it to the next step. More to the point, they have technologies, they have business ideas, they have markets that could benefit from a huge infusion of capital. And part of our job is to help bring in the right controls to document everything that's happened in the past and get them ready for a transition to a publicly traded company. And as part of that service, we do look at the founders who may have been working with the company for 5, 10 years. They are the holders of the stock. They're probably a very few, sometimes one main shareholder. And our job is to prepare their estate so that when we create the value and propel their estate into a very significant amount of money, that they don't give half of that wealth to the IRS at some point in their life or after they pass on. And we make sure that as much of that can get to the heirs as possible. And that's what a trust is all about. But the thing you have to realize is there's a lot of different kinds of trusts. There's probably a dozen kinds of trusts and a dozen ways to set up estate planning to try to capitalize and try to retain as much as possible. We tend to shoot for one particular type that helps to retain the capital, and we'll go into that in a minute. But first, we're going to go into some basics so you understand the playing field, so you understand some of the challenges that we're up against, some of the issues that you run into, and some of the hazards that we're trying to avoid. So what we're going to talk about next is a basic understanding of gift tax. Okay, so that's our next topic. Okay. So let's talk about gift tax. The U.S. government says that you can give away about, it changes every year, but about $14,000 each year to anybody you want. Now, you can give away that to 50 people, so it could be $14,000 times 50. There's another trick to it, and that is that your wife or spouse also has the ability to give away another $14,000 a year. So if you have, let's say, 5 cousins, 2 kids, an uncle, an aunt, all these people, you may be able to give away, let's say that's 12 people, and you and your spouse could both give it. If you have a spouse, that might mean 24 times 14. It starts to be a lot of money. It starts to be $200,000 or $300,000 every year. So it's not an inconsequential amount that you can get out of your estate. But it is, and mind you, it is a wonderful way to get money out of your estate. And we highly recommend moving money out of your estate using the annual gift tax, because over a 10-year period, it can turn into a substantial amount of money. However, our clients run into an issue where they may come into 50 million, they may come into 100, they may come into $300 million in a fairly short period of time, and the gift tax strategy simply does not provide for that level of distribution of the estate. And if the money gets caught in the estate when the shareholder passes on, you can lose as much as half of it or more. So it's a very important thing to make sure that it's treated properly. And the time to work out that strategy is before the stock becomes hyper-valuable, to do it as early as possible when the stock is at the lowest value possible, and that gives us the ability to push the increase in value onto future generations, and that's the goal, is to catch it early. So that's the basic idea of gift tax. The IRS has granted a $5 million exclusion of estate tax, so that in your life, when you pass, you can pass up to $5 million worth of assets onto your heirs without paying estate tax. Unfortunately, for most of our clients, their estate is going to be into the $100, $200, $500 million range, and that $5 million isn't going to begin to get it. Therefore, we need to move the assets out of their estate, reduce their estate, and make sure that the bulk of their money is already been transferred into a trust. Okay, let's talk about how an irrevocable trust works, okay? And that's what we're recommending, is an irrevocable trust. It is a third party. It is considered another person. It's another legal person. And when Joe dies, it sails on into the sunset. There's no obligation for them to sell any of the stock. They can keep it for another 5 years while it appreciates. There is no estate tax due because it's another person, and the other person didn't die. The trust was alive when he was, and the trust kept going after he died. It was the non-event. It's similar to Microsoft. If one of the shareholders of Microsoft dies, Microsoft doesn't stop. It doesn't do anything different. It's just different people own it. Who cares? So everybody just carries on as if nothing happened. So that's the benefit of an irrevocable trust. Here's your problem. If you take, let's say, $50 million and you put it into a trust that's an irrevocable third-party trust, that a trust for the kids. Okay, fine. Problem is that $100 million is a gift, and it gets taxed at approximately 40%, goes on your personal tax for that $100 million. So if you give $100 million to a trust, you just gave yourself a $40 million personal tax bill. So that's not going to work so good. It sounds easy, just give it to a trust, but the problem is it doesn't work, because you'll just be hit with the gift tax. Okay, so that's our discussion of gift tax. Now the next section, we're going to talk about how we get around that, how we manage that, and how we minimize the impact of that. Okay, now you're going to kill me, but we have another basic idea to discuss. That's the idea that when money gets loaned, if I loan Joe $1,000, that's not income to him because he owes it back to me. And when he pays it back to me, that's not income to me. All he's doing is repaying a debt. If I pay money out if I loan money to him, I can't write it off as an expense because it's not an expense. He owes it back to me. So basically, it's what the IRS calls a non-recognition event. It just means, look, it doesn't matter for either of you guys. It's a loan. You give it back. Nobody gets to write anything off. Nobody gets to call anything an expense or income or anything. We just ignore it. Okay? So that's an important concept. Now, we use that concept in constructing our trust. Okay? So here's the deal. If I take Joe's okay, so Joe has his Yoyodyne stock, right? Worth $10 million. If we give it to a trust, give $10 million to the irrevocable trust, but have the irrevocable trust write a promissory note back to Joe for $10 million. Okay? If we agree that the stock's worth $10 million, puts it into the irrevocable trust, then the trust writes him a promissory note back. You can see that that's not a gift. That was not a giveaway. Therefore, no gift tax due. Okay? Woohoo! So we got the stock into the trust. We got the money into, or heck, you could give it to your buddy down the street. You could give your stock, get a promissory note back, and again, no income, no gift, no nothing to anybody. It's just a non-recognition event. Okay. So this is the structure that we come up with, where we give a guy's stock to a trust gives back a promissory note, nobody's the wiser. Now, in Joe's case, we know that we're going to take Yoyodyne and we're going to take it public. So what's going to happen is, when he gave the stock to the trust, it was worth $10 million. But then we pumped it up and made it worth 200 million, right? Because we took him public. And we put a bunch of money in, we brought a bunch of new people in, maybe he bought a couple extra companies, we blew the value of it through the roof, okay? Well, what happens now is the trust is sitting on $200 million worth of stock. Woohoo! And it still owes him back the 10 million. So what it does, once, a year, 2, 3 down the road, after all the dust is settled and after the market has understood what a great company this is and have fully valued the company, now the heirs can go ahead and sell some of the stock, enough to pay off the 10 million, pay him off, and they still have $190 million in the trust. And that's not taxable until they go and actually sell the stock. Okay, when they actually go to get rid of the stock, now they're going to have to pay tax at each time that they go to the stock. Each time they call, Charles Schwab and say, sell 300 shares, that's regular income to them. But otherwise, the 190 of come up is tax-free for however long they want to hang on to it until they finally go and cash it in. So you can see that the promissory note is a great way, and we attorneys consider that, it's called freezing the value of an asset, okay? Now, that brings us to one more question, and that is, the IRS is going to be mad if they feel like we gave a $10 million asset and we only gave a $1 million promissory note back. In other words, they want to know that what we gave to the trust was worth 10 million and we got a 10 million promissory note back. Because the only way that it's a non-recognition event is if we got a promissory note for the correct amount of, equal to what we gave to the trust. So the IRS is going to be very ticklish, and they're going to really want to know that we didn't give something worth 10 million and only get a promissory note back for 1 million. That would be a gift of $9 million to the trust. Okay? I hope you're following all this. Okay. We're going to talk next. We're going to talk a little bit about what the promissory note has to look like. Okay? See you in the next section. Now, the promissory note. In order to have a legitimate promissory note that will survive IRS scrutiny, we're going to be very careful. Point 1, we're going to value the company. Okay? Before we do any business here, we're going to get a CPA, a licensed CPA, to do an actual appraisal. There are IRS rules about how you do the appraisal. There's actual code sections, and I'll hopefully put some here, that actually mandate how the appraisal has to be performed. There are individuals called IRS engineers who can actually come along with the CPA, look over his shoulder, and work with him to actually make sure that the IRS is happy with the methodology. There's actually a review group that will actually look over the appraisal of a company and see if they're comfortable with the way it was done, and if it was thorough, and if it was well documented, and if it wasn't flim-flam, okay? Because there's opportunity for fraud here, and the IRS is very concerned about, the possibility that people are going to take advantage of the system. We don't want to do that. We want to have a right-on-the-money appraisal. We want it to be 100% legit. We want it to stand up to any IRS audit, okay? We want to go overboard to make sure it's completely legit. So Joe at Yoyodyne has the appraisers in. Hopefully we have an IRS engineer who's willing to come along, and we get an appraisal. It's expensive, but there it is. Then we know that the IRS says, okay, we agree that the stock is worth 10 million. Great, now we've got that. Now we can transfer into the trust the 10 million worth of shares, and we get back a promissory note from the trust saying $10 million is owed. And the IRS sees that as a non-recognition event because they have certified that the appraisal was correct. Now, the promissory note also has to be properly documented. You need attorneys to do that. It's got to be a full formal document with all the niceties involved in it. Secondarily, that has to be the correct interest rate. The IRS has something called the applicable federal rate, the AFR. And the AFR is the official rate that they want to see as a minimum charge on that promissory note. Now you can go higher than the AFR, but they want to see no lower than the AFR, otherwise they consider it a sham transaction. Now, Right now, the AFR is a completely complex thing. There's about 10 different ways you can look at the AFR, 10 different numbers that it could be, but it's typically in the area of anywhere between 0.5% and 2.5%. It's very complicated. There's long-term, short-term. There's all these things. But anyway, suffice to say, you got to do it by the book. You got to have the right number. Then you've got a promissory note that will hold water. Now we can all go home and know that we have transferred the asset. There is now an IOU that will hold up because the asset was valued correctly and formally. The note has been done correctly and we've observed all the niceties. If we get audited, we can go to the IRS, give them all the documentation, and they will see that this is a non-recognition transaction between the trust and Joe. There is no taxable event that happened, and most importantly, there's no gift tax owing. Okay, so far in our journey, we've understood that we do not want to get caught with the assets in our estate. We solved that problem by putting it into a trust, an irrevocable trust. So far, we've understood that we've solved the problem of putting the assets into the trust and escaping gift tax, because otherwise we get hit with gift tax. So what we've learned is that if we do it and we have a promissory note coming back, that it's not a gift tax situation, as long as we set it up just so, as long as we're perfect in terms of valuation and setting up the promissory note correctly. So we've eliminated the problem of putting the assets into the trust. So now we should be done, right? Okay. There's one more trick. So first of all, we've done pretty good here. I mean, we've gotten the assets out of your estate. We have done it without incurring gift tax, and life is good. But we're going to add a cherry on top, okay? We're going to put in a little bit of language that the IRS says defeats the trust. Now, for estate taxes, the trust is good. For gift taxes, the trust is good. But for IRS taxes, the trust is not good. Okay? We do this by putting in one lousy paragraph that allows that creates certain problems, and the IRS says, well, if you have that paragraph in there, we're going to disregard this trust. So let me tell you what this does. What this does is, if the trust gets income, now remember, I said when the trust gets income, the trust would have to pay its own taxes, okay? Whereas, so it has to pay its own taxes. But we can do a little trick here. By putting in that one paragraph, we can actually make it so that when the income comes in to the trust, the income is taxed to Joe, the owner of Yoyodyne, okay? The guy who put the trust assets up. Okay, let's do that again. So $1 million comes into the trust, and the trust gets to keep 100% of the million. It pays no tax. And the tax flows through onto Joe's personal income tax, and Joe pays $400,000 tax on it. Okay? That's another way of transferring assets to the trust. For some people, that's a valuable additional feature. So that remember, if we don't put that paragraph in, the trust pays its own taxes. $1 million comes in, 400 goes out, no problems. If we do put the paragraph in, the $1 million comes in and Joe pays the taxes. That structure is called an intentionally defective grantor trust. Okay? So it's a trust that got set up, and we put in one little paragraph, and that allows the income to flow to Joe. Some people feel that that's a nice way to transfer even more wealth from their estate into the trust, because every time a dividend comes in, every time rent comes in, the trust keeps 100%. Joe has to pay the taxes. More money left his estate, more money went into the trust. Okay? Some people find an intentionally defective grantor trust to be an effective mechanism to continue shifting assets out of their estate and into the trust. And other people's attitude is, let the trust pay its own taxes. Strictly a personal choice, and it's up to, it really depends on, how much your tax rate is and all kinds of personal features like that. Okay, so let's review what we've learned here. Number one, We started off with Joe, $10 million stock in Yoyodyne. Okay? Step 2, we had the company appraised. We have an exact appraisal now. Step 3, we set up a trust, an irrevocable trust, and we may put in that special paragraph for the IRS that allows the taxes to flow through to his personal tax, or we may not, depending on his tax situation. So we set up the trust. Then we will transfer the stock, once it's valued, into the trust, the irrevocable trust, and then get back the promissory note that has the right guarantees attached to it, that should be repayable within his lifetime, probably 10-year duration. It has no prepayment penalties, and it has all of the niceties so that he gets a promissory note back. Now the transaction is essentially complete. He now has gotten that asset out of his estate. The asset is now prepared to go through the roof. Okay, well, that wraps up our presentation. I hope you enjoyed this video, but do not use this as legal advice. Go and get your own counsel, and hopefully this video will give you some of the fundamental ideas that you should use in talking with your CPA, talking with your attorneys, and structuring these kinds of transactions. The trust ideas that we've talked about here are especially valuable and appropriate for entrepreneurs who are on track to take their company public and whose net worth is about to become 10 to 20 times larger than it was before. Thanks for watching. I hope you got some good ideas. We'll see you on the next video. Bye-bye.